Welcome back to another video. In this one, I will be providing some supplementary content for the unicorn model lecture I released last week, as a lot of people enjoyed it. In this video, I wanted to highlight a simple way to determine higher timeframe bias by utilizing timeframe alignment. In this case, I will be using the daily, the hourly chart, and the 5-minute chart to dissect price for the mechanical unicorn model entry that I presented last week. Before we begin, I wanted to include a Q&A section as well. So some common questions I got from the previous lecture was, number one, should we avoid high impact news days? And my answer would be, I only avoid FOMC, NFP, CPI, and PPI news events only because they're so incredibly volatile that trading those news events would just be gambling at that point. The second question was, if we can't see a clear daily bias, should we avoid trading? And my answer to this would be yes. And the reason is because, and I got this from the MMXM trader, where he says, do you ever have those days where price is so painfully obvious to you that it's going to go somewhere, and it actually does? And if you have those days, then those would be your trading days. And the more experience you gain in the market, you'll have more of those days where price action is just painfully obviously reaching for something, and you'll have more trading opportunities. But until then, just stay sidelined until you think price action is so obvious it's going somewhere, and only trade those days. Otherwise, I would suggest just studying the other days, and over time you'll develop that intuition that a lot of professional traders have, and eventually you won't even need to use the unicorn model. You can just trade discretionary, right? And the final question was, is internal to external or external to internal the only way we need to determine a bias? And my answer to this would be yes. The market trades from internal to external or external to internal liquidity all the time. So with this in mind, one could purely use this as a bias builder. And in this supplementary lecture, I cover how on the daily I am only using internal to external or external to internal to build my bias. So for this lesson, I decided to start from July 2023 because this is the final quarter of the year. And every quarter of the year, I look for a quarterly shift. This quarterly shift can be spotted between correlated markets. And in this case, I would be doing it for indices. So between ES and NQ, we had a bearish divergence at the highs here where ES took out this high, NQ failed to take out this high, and then we created a swing high, displaced lower through these lows. And this would signify to me that the markets are shifting bearish. On top of that, we had this projection from the previous quarter for this final leg of price pushing upwards, and around the -2 to -2.5 standard deviations. This is where I expect a change in state of delivery in the algorithm, meaning we're going from buy side of the curve to the sell side of the curve. So I can annotate that here for you guys as well. So buy side of the curve to the sell side of the curve. And this SMT divergence with the quarterly shift just basically confirms that bias. But nonetheless, let's get started. And I'm going to just draw the current dealing range that I'm looking at, which would be this high to this leg. And if you are using dealing ranges, then this range right here is what you'd mainly be focusing on, because once we take this external range low, that's when we have that true market structure shift. So with that out of the way, I wanted to explain how using the unicorn model in alignment with higher time frame bias will greatly increase the odds of your take profit being hit. And on top of that, you can target larger profits as well. So let's get started, where let's just play this out a little bit and wait until this low is taken out. And let's just say none of this other analysis is involved. So we're just using the dealing range right now, which would be this low to this high once again. So I'm waiting for this low to get taken to confirm my quarterly shift. So once this low gets traded into, right, this low would be considered the external range, right? So once we take external range liquidity, I would want to see a internal range liquidity. And in this case, it would be this fair value gap right here. And so just by doing that, now my bias is already bullish. So let's just draw this out really quick where it's inside right. And then now because this low got taken, right, I'm now looking for a new range, which would be to this low, this high to this low now. And this is what I'm looking for. So from here on out, I would be looking for this internal range. Unless I get some sort of swing high and displacement lower, then I would target the next external range liquidity. So let's see how this plays out. We have a displacement downwards with a swing high. So the most obvious draw on liquidity right now looks like this low. So let's see how price plays. Let's just say I'm sidelined for now until I get clear evidence that we are going for this internal range liquidity. We take this external range liquidity. Our next target would be down here if we continue lower because that's the next liquidity. Let's see where price wants to go. We get some kind of rejection here from this fair value gap that we see on the left. Let's see if we can get a close below it. And we get a swing low here. So I would draw my range even lower. This is still the only internal range liquidity I see that is in a premium. So within a bearish range, I'm waiting until price trades into a premium internal range liquidity to continue bearish. So from here, I know that we have traded below external range liquidity. Let me delete that. We have traded under that external range liquidity. And now we have traded into an imbalance where smart money can offload their position. And so now I'm looking for price to trade higher. We get this swing low here that confirms that we are going higher. And from here, using time frame alignment, I would drop down to the lower time frames to look for any reason to go long in this case. Let's drop down to the 1 hour. So from here, I can see that we had a market structure shift on our 1 hour within this higher time frame area of interest. So once we have that, we're looking for bullish price action. So from here, we can look for setups to go long with the unicorn model because our higher time frame bias is bullish. So let's go down to the 5 minute. Mark out our 9:30 to 11:10 and look for any bullish unicorn model setups to form within this 9:30 to 11:10. We do not have one that forms within this time window, so therefore on this day we would not trade it and continue looking for bullish unicorns going forward. So let's skip to the next day. Remember, our higher time frame is still bullish. Let me just mark out 9 o'clock. And then we can go back to our 5 minute and look for any reason to go long with that bullish unicorn model. So instantly, when I'm looking at this, I already see that we have a low, a high, right? So if we trade through this high with displacement, I'm looking for that unicorn model to form. So let's see if this forms. And mark out 11:10 as well. So this is now invalidated because we created a new low and new high. So now I'm automatically looking at this low and this high. If we trade above this high with displacement, then I'll be looking for a unicorn. Which we do not get this day as well. So in this case, we have no trade this day and continue waiting. Go back to our 1 hour. Remember, we are still bullish until we reach that higher time frame level, which is all the way up there. So let's just continue to the next day at 9 o'clock. And from here, drop down to our 5-minute to look at the 9:30 to 11:10 and see if we get a bullish unicorn model to form. So from 9:30 to 11:10 a.m., I can see that we already have a unicorn model form kind of a little bit before. So we have a low, high, lower, low, and then higher, high here. So if we came back to here within this fair value gap, I would be interested for a long and also this breaker block right here where they overlap. And then so I would place my limit order where the breaker block meets the fair value gap. They overlap. And from here, put my stop loss above the candle body of this order block that is deemed high probability because it has a fair value gap overlapped with it. So from here, I would place a limit order and target 2R since our higher time frame is bullish once again. So if it comes down, it's higher probability that this unicorn model will play out. Which in this case, it does not play out. So on this day, we have no trade once again. And so now let's go back to our 1 hour. Look for the next 9 o'clock. Be Thursday at 9 o'clock here. At 9 o'clock, we are still looking. Remember, our higher time frame is still bullish. So we're still looking for that bullish unicorn. So dropping down to our 5-minute, we draw out our vertical lines at 9:30 and 11:10 once again. And from here, I'm looking for that bullish unicorn model. Which we do not get. So once again, no trade day. Going back to our 1 hour time frame, I'm now looking once again. Okay, so we had this massive displacement. So let's go look at our daily and see what's going on here. So I'm still bullish on my higher time frame, right? Now I recognize we took this high and we displaced lower, but where are we reaching for, right? We have this fair value gap right here. And going back to our 1 hour, I would like to see some kind of bullish reaction from this specific area of interest on the higher time frame so we can trade higher into our final objective of this bearish range. So from here, I'm just going to play it out. Once again, Friday at 9 a.m., I'm going to put my vertical line. See how we react. And it seems like we are supporting from this. So once again, our higher time frame is still bullish, right? So we're still looking for that bullish unicorn into this higher time frame area of interest, which would be that daily imbalance. So let's drop down to our 5-minute once again and look for a bullish unicorn to form. So from here, I don't see anything too interesting so far. Just let price play out. And from here, it looks like there was no setup this day as well. So this whole week was a no setup week, but that's okay because we're keeping it very mechanical here. So let's go back to our 1 hour and look for the next week at 9. So that would be Monday at 9 o'clock. So from here, drop down to our 5-minute once again. And then we're going to be looking for our bullish unicorn model. So once again, draw your line at 9:30 and 11:10. Waiting for that unicorn model to form. Right now my eye draws to this high and creating this breaker right here with this up close candle. Let's see how price plays out. And once again, looks like a no trade day, but this is a Monday as well. So expect consolidations on Monday, most likely, when there is no news. So let's go back to the 1 hour and play it out till the next day at Tuesday, 9 o'clock. And from here, drop to the 5-minute once again, 9:30 to 11:10. And now we're looking for that bullish unicorn once again. So in this case, you actually had a setup where you had a low, high, lower low, and then displacement up to this higher high. And you would have highlighted your breaker block, which would have been this up close candle right here. Within this, there is a fair value gap that creates your unicorn model, right? And you would place your limit order where the breaker block and fair value gap overlap each other, which would be the high of the breaker block in this case, because the fair value gap is actually larger than the breaker block. So from here, we're looking for our high probability order block. And the only high probability order block I can see would be this order block over here that's down closed candle, because it has the fair value gap nested within it. But to keep things simple, another thing you guys can do is place it below the manipulation. And you can target 2R as well. That would work. But if you wanted to do it the same way I do it, then I would have put it under this candle body low, because it's a high probability order block. And then I would have just targeted 2R, which would be a very quick scalp right here, right? But once again, if you wanted to use the whole order block and the manipulation, then you use that low, target 2R. And that would have been your trade right there. So let's continue on. And remember, all of these we're looking for long setups because our higher time frame is bullish, right? So keeping that in mind, I'm only looking for bullish unicorns. When you get more discretionary with this, you can look for both directions of the market, but I just want to make this as mechanical as possible for you guys, so that way you guys can backtest and have a rule set to follow. So back to our 1 hour chart. I'm now going to plot out the next day at 9 a.m. Waiting for that 9 a.m. And once that occurs, dropping down to our 5-minute, looking for that bullish unicorn setup. Once again, vertical line at 9:30, vertical line at 11:10. And from here, I see that a unicorn has already formed, right? So we have a low, a high, lower low, and then now a higher high. We have this breaker block, the highest up close candle. Or you could have used this one as well that we displaced through. So in this case, it doesn't matter as much, but if you wanted to, you could use this candle as well, because we displaced through this up close candle, right? So I'll just use this one to kind of give you guys an idea of a more discretionary breaker block. And then we have a fair value gap nested within it. Once again, I would set a limit order at this breaker block high, because the fair value gap is higher than the breaker block. So where they meet is at the high of that breaker block. From here, I'm looking to place my stop loss at the candle body low of this high probability order block. I could place it here, or once again, you can place it at the manipulation low and target 2R, which lines up with our higher time frame draw on liquidity, right? Which is that internal range liquidity. And let's see how this plays out. In this case, this one would be a loss. And then let me just leave this here and see if we get another opportunity on the same day. In this case, you would have just taken a loss. So overall in this backtest session, we won one trade for 2%. Now we lost one trade for 1%. So let's continue moving on. And back to our 1 hour chart. And annotate the next 9 a.m., which would be Thursday at 9 a.m. Okay, so from here, drop down to our 5-minute chart once again, 9:30 to 11:10. And from here, you have two choices, to be honest. Is one, once this higher time frame objective has been met, you can either decide to sit on the sidelines, or you can trust that the lower time frame will most likely dig deeper into that higher time frame array. So a general rule of thumb is that if the 50% of the array has not been touched yet, then you can generally continue using it, is how I like to do this mechanical model. And in this case, you had this unicorn model form. So you had a low, a high, lower low, and a higher high, right? I can annotate this for you as well. So we had a breaker block, this highest up close candle with a fair value gap with it, right? We could use these up close candles too, but there's no fair value gap with it. So in this case, we're just looking for this breaker block because it has the fair value gap with it. And then we use the fair value gap, annotate that for you guys. And we also have the high probability order block, which would be this order block right here. So in this case, mark your chart at 9:30. Once that forms, put your limit order on the breaker block high in this case, because the fair value gap is larger than the breaker block. And then your stop loss below either the high probability order block or the manipulation low. Either one works. And then you would just target 2R. And that would be your trade for this day. So I hope that was helpful for you guys, and I'll type it out for you guys really quickly what we went over. So we went over time frame alignment, right? So daily to hourly to 5-minute, right? So that was our time frame alignment, okay? And so this is what we did on each time frame. Daily was looking for the overall range structure, or sorry, dealing range. And then your hourly was just confirming market structure shifts, right? And how the daily arrays are being respected, right? So we will use our hourly chart to confirm market structure shifts for the daily chart, where we're expecting a change in states of delivery. And then we also use it to confirm and understand how price is respecting that daily PD array. And then next we have our 5-minute unicorn model entries only in alignment with the higher time frame bias, right? So that's exactly everything we went over in this video. I hope that makes the unicorn model look a little more mechanical for you guys. And if you guys have any questions, as always, feel free to ask me. You guys leave a comment and stuff like that. I'll make a video of it in the future. I just like to wait for all the questions to come in first, and then I'll make a video on it. So yeah, I hope that helps you guys and is insightful. As always, have a great day.